Hey guys, it's Dave. Welcome back to the channel, and before I get into anything else today, I just want to give a quick thanks to Keith and Ghost Eye, both who have been watching the channel for a very long time. Very much appreciated, and they actually became the first channel members since I just enabled this feature on my last video. I really didn't expect anyone to sign up to be channel members, still quite surprising, but very much appreciated. And I'll be having a beer on you guys very soon, don't you worry. So with that out of the way, I wanted to take a look at a few space companies that seem to be getting close to the breaking point. Their cash reserves are dwindling, they've been burning money quarter after quarter, and really we're getting close to the make or break moment for each of these three companies. There's really three options for them going forward. They either somehow break even on a net basis very soon, within, say, the next couple quarters, or they manage to raise additional capital, whether through dilutive funding rounds or, raising debt or things of that nature. Or the third option that is getting more and more likely with some of these companies is bankruptcy. And we already saw this play out with Virgin Orbit. They were kind of the first domino to fall with this new group of aspirational space-backed companies, some of which had absolutely amazing technology and are very interesting, but really a lot of them I think may have come to the public markets too early. They didn't raise enough capital, and now they're kind of paying the price because they're running out of money and the capital doesn't seem to be there like they expected. So let's take a look at each of these three companies, talk about which ones we think are most likely to be able to stay in business, and talk about just how bad their situation may or may not be. Before we dive into that though, I hope you'll consider subscribing by the end of the video if you do enjoy it. Every subscriber is very much appreciated, and I'll be checking out your comments down below. Many of this channel's viewers will already be familiar with Astra Space, but for any new viewers, this is just a brief overview of the company. Initially founded back in 2016 with the goal of meeting growing demand for small launch satellites, the leadership of the company was largely formed by the duo of Adam London and Chris Kemp. London has a PhD in aerospace engineering from MIT, as well as a fairly impressive resume of work experience, and he has been considered largely the technical mastermind behind the company. Meanwhile, Chris Kemp had a history of entrepreneurship as well as working at NASA Ames and a few other endeavors. Over the years, Kemp has turned into quite an interesting character and polarizing figure. He's famous for always wearing all black and very much always cared about Astra's image with the public as well as shareholders, and has turned into a little bit of a hype man for the company in order to try and raise as much capital at favorable terms as possible. While the company did succeed in ballooning to lofty valuations on the back of increasingly outlandish claims such as daily launches, something that there doesn't even appear to be a demand for in the market, several high-profile failures ultimately led to the cancellation of their Rocket 3.3 system, even though it did eventually make it to orbit. Astra then pivoted to a larger Rocket 4.0 as the focus for the future of the company. Unfortunately, as cash reserves dwindle and a first launch for that vehicle was still relatively distant, Astra has pivoted once again to focus on selling spacecraft engines in an attempt to stay afloat. This division came from an acquisition Astra made of another company, Apollo Fusion, and represents the only section of the company actually bringing in revenue today. Time is running out for Astra, and it remains to be seen if this small division of the company that was once considered an afterthought can keep Astra afloat long enough to break even, make a profit, and turn their focus back towards rockets. Okay, so Astra, I think a lot of you already know, a company I haven't been too crazy about. I feel like management and maybe CEO made some really bold claims that caused retail investors to get extremely excited and pile in. The stock went through the roof. Everyone was happy. And then obviously things plummeted, and I just feel really bad for any retail investors who got caught up in these situations. But Nevertheless, where we are with Astra right now, let's take a look at their balance sheet. And by the way, I think it's important for every investor to be able to look at balance sheets. It's freely available. I never used to do it back early on when I started investing, and I feel like I'm much better for it now, much better investor. Some of the trades I made back when I was younger, I never would have done it if I just looked at the balance sheet and saw how much money they had and stuff like that. So let's take a look at Astra here. We're going to go with a quarterly view because we have some more recent numbers there. And first of all, we can see total cash currently around $26 million. That's very low for any company to have, a company on the NASDAQ to have even, let's say. And let's take a look at, how much cash they've been burning through every quarter. It's pretty clear here. 200, 150 next quarter, 102 next quarter. They managed to tighten their belts a little bit here and go to 62 million the next quarter. So we're looking about 50 million burned, 50 million burned, 50 million burned, 40 million burned. So they're trying to do what they can. I do respect the fight, the trying to stay alive. I definitely respect a lot of the employees working there who are just trying their best. But the cash burn from this last quarter is now down to more like a little, 30 to 40 million dollars, right? And we only have 26 million. So that's basically one quarter's worth of cash. And keep in mind, these numbers are as of June 30th. We're getting into late August now, guys, so it's almost certainly worse than it was, although there have been some moves to help prop that up from Astra. We'll take a look at that too. Other current assets are on the book. This isn't really liquid stuff, but they do have some receivables due to come in, some inventory that is theoretically worth money, and other current assets. I wouldn't expect them to, be part of paying, employee salaries. Then when it comes to current liabilities, because they also have debts and liabilities, $81.9 million, far exceeding the current assets. Never something I want to see personally. Then just taking another look at their results and what they talked about in their press release. They are saying they remain intensely focused on near-term deliveries of their spacecraft engines so they can get paid to try and stay in business. They also say that in Q2, they continued to closely manage their financial runway and evaluate strategic opportunities. This word, this phrase, evaluating strategic opportunities, every time I see it, it looks like something has gone very wrong for a company and they're in trouble. Yeah, I mean, it sounds nice. We're just evaluating our opportunities here. But I think in reality, it means, we're in trouble. We're looking at layoffs. We're looking at loans. We're looking at trying to sell the business and get taken over, or anything we can not to go bankrupt is basically how I read it. So they did announce, at least on August 4th, that they received a senior secured notes offering to raise a bit more money, so that'll help for sure. They're also decreasing their general administrative expenses as much as they can, 52% decrease. That's very solid. Probably should have done that a year ago instead of now. And additional savings of $4 million a quarter. We saw, burning $30 million a quarter. While nice, $4 million will help. It's not enough on its own. And then just looking at the financial highlights, as we said, net loss, this is adjusted, so in reality it's probably worse, but adjusted net loss was $33 million. They have $26 million left. That leaves less than one quarter of runway, and then, minus some additional debt they did raise that does on its own need to be paid off at some point. What they're saying for next quarter is that they expect cash and cash equivalents to be between 15 to 20 million. So that's a massive reduction in burn rate. And if they do pull this off, I will applaud it, although it's also partly due to raising additional debt. But that basically means they're going from 26 million to 15 to 20, so still burning, a quarter to a fifth of all the cash they have remaining in just a single quarter. Pretty scary stuff. So that's the situation Astra is in. Definitely make or break time, definitely moment of truth time. Virgin Orbit already went through it. We saw what happened to them. Hopefully Astra will have a better fate. We'll have to wait and see. It's one I'm going to be watching very closely. I'll give you a bit more opinion later on when we go through the other two companies. Momentus Space is a space transportation company that aims to revolutionize satellite deployment and transportation in space. Founded in 2017, the company specializes in providing in-space transportation services for satellites and payloads, offering cost-effective solutions for moving satellites to their desired orbits, conducting orbital maneuvers, and enabling other in-space activities. Momentus was founded with the goal of addressing challenges associated with getting satellites to their precise orbits once they have been launched into space. The company recognized that the traditional approach of relying solely on a rocket's primary payload deployment wasn't always optimal, especially for small satellites on rideshares that often end up in suboptimal orbits. Momentus has developed a proprietary water propulsion technology for their space tugs. The tug can be attached to a rocket's upper stage or directly to satellites, uses water as a propellant which is heated to create steam and generate thrust, enabling orbital transfers, inclination changes, and other maneuvers. They also offer end-of-life services such as deorbiting satellites to reduce space debris. So here we are again, Momentus Space balance sheet. Let's take a look at the quarterly numbers. And obviously, first off, you can see right away the share price well below $1. Once again, never a good sign, obviously. And total cash on hand, we're going to home in on that first. 21 million, so even less than what Astra had. Burn rate, let's take a look at that. 110 million to 81 to 61 to 38. So we're trying to look at about 20, a little less than 20 now is their burn rate, and they have 20 million in the bank. So again, about 1 quarter, maybe a little over 1 quarter's left, of cash left to pay the salaries and stuff like that. And keep in mind, once again, these numbers were as of June 30th, so they've probably burned more capital already since then. Taking a quick look at long-term liabilities and total liabilities, we're looking at 35.9 million. A few more details from the press release of their earnings call here. So we have in Q2 of 2023, they did grow their revenues by 3,310%. That's extremely impressive, but you have to remember it's growing from almost nothing. So 1.7 million is not actually that much money to be making in revenues. It's just the fact that it's growing from so little that the percentage numbers sound very impressive. So they have been working to raise additional capital while pursuing and evaluating strategic alternatives. Similar wording to what we heard with Astra, and I think I already told you my interpretation of what that usually means. Now, they did sign a contract here for about $746,000. Not bad, not enough to save a company that's burning, call it 18 million per quarter. Hopefully it helps, though. And a lot of red flags going on right here. So I would be very worried for Momentus and their investors right now. Continuing on, they did have another item of views. While they cut their workforce and evaluate strategic options, kind of like I said, evaluating strategic options is like, oh crap, oh shit, what are we going to do? Let's evaluate. Does anyone want to buy us out? It's kind of, I'm pretty sure if we go back to the press releases Virgin Orbit had when they were going through these issues, you'll probably see somewhere quoted, we're evaluating our strategic options. So, similar to Astra, they're doing what they can, tightening their belts, slashing their workforce by 30% as they try to raise funding and look for strategic options. So that is our number 2 company that is about to hit their moment of truth, their make or break point where they're going to have to find some money from somewhere, go bankrupt, or somehow go from burning 18 million a quarter to profitable in 1 quarter. Redwire Space is the result of a merger between 2 established space companies, Adcol Space and Deep Space Systems. This strategic merger brought together decades of experience in space engineering, manufacturing, and technology. The goal was to create a unified entity capable of providing a wide range of innovative solutions and products for the rapidly evolving space sector. Redwire operates as a vertically integrated company offering end-to-end solutions and products that span the entire space industry. Their business model revolves around catering to various aspects of space exploration, satellite technology, and in-space operations. Here's an overview of some of their primary business areas. Space infrastructure provides solutions for constructing, assembling, and maintaining infrastructure in space, including components like solar arrays, deployable structures, and truss systems for satellite deployment and station construction. Spacecraft Systems offers advanced solutions for spacecraft design and development, including systems engineering, avionics, communications, propulsion, and more. In-space manufacturing and assembly is aimed at reducing launch costs and increasing efficiency by producing complex structures and components directly in space. Space Robotics develops robotic systems for a variety of applications in space, such as maintenance, inspection, and assembly. Advanced Materials, which is pretty much self-explanatory, and energy solutions, including solar power solutions for space missions such as the International Space Station. So while Redwire does not perform launch itself, it is focused on taking advantage of the trend of lowering launch costs and mass to orbit today and in the future. They also do have several systems on the International Space Station right now. Okay, number 3 is actually Redwire, and you can see right away, this one, at least in terms of share price, still well above $1, which means it's not in danger of being delisted, so I guess that's a bit of a bright spot for the company. And let's take a look at their cash situation. Going again quarterly, the lowest number of all, actually, in terms of total cash, only looking at $11 million right now. However, total current assets is much better. Receivables are looking higher. Total current assets, $89 million. Total current liabilities, $275 million. I'm not going to lie, I didn't actually check that before filming right now, and I'm just a little taken aback at how high it is. They've got some long-term debt here, $75 million. Yeah, so total liabilities here, much higher than total current assets. Even non-current total assets overall, $251 million versus total liabilities, $275 million. Anyway, continuing on. Total cash. Let's look at the history. This one's a little different. So they had $10 million and then $7 million, and then they raised more money, so they went up to $28 million. Then next quarter, they were at 11,273, and now they're at 11,231. So a little bit steadier, really, and it's because they seem to keep raising, small amounts of money to keep afloat. So we want to see, did they burn a lot of money this quarter? Did they break even, or did they get more debt that makes this total cash number look flat, but really, they're just adding on debt. So let's continue taking a look at their most recent earnings call. Here we have 63% revenue growth from Q2 2022 to Q2 2023, so that's year over year. Very impressive revenue growth numbers, obviously. Anytime you get 40, 50, even 35% is pretty solid usually for most companies. So clearly they are getting better, and their contracted backlog is growing, 68% growth on that front. And then when it comes to the financials, we had $60.1 million in revenue. The net loss was $5 million. So they lost $5 million, even though we saw that the revenues were flat on the balance sheet. They must have raised, about $5.5 million from somewhere to kind of keep that the same. Interestingly, though, they do become free cash flow positive, and they do go EBITDA positive, adjusted EBITDA positive, I should say. Obviously, that doesn't take into account things like taxes, interest, depreciation, all that kind of stuff. But that, that's something that helps out for sure. So there are a few signs for hope perhaps here, although they do still have a lot of debt, and the cash on their balance sheet right now is actually the lowest of the three. Taking a look at their liquidity and how much money they have available, we're seeing that at the end of June 30th, 2023, they have cash and cash equivalents of 11.2% and borrowing capacity available of 25 million. Sorry, I shouldn't have said percent. 11.2 million and borrowing capacity of 25 million. So obviously this money here, not theirs, but they can borrow it and then they would still need to pay it back. So that's kind of what they have to stay in business. Let's take a look at some of the news reports after they released these results. So a little bit more of an upbeat title here. We're not talking about strategic options. We're saying that Redwire reports a record revenue as it seeks profitability. Scrolling down, they're talking about how for the first time since going public, they reported positive adjusted earnings for the quarter. Again, that before interest, taxes, depreciation, amortization, all that stuff. But still, a positive number is nice to see after all these negatives, right? CFO is quoted as saying that Redwire's path to profitability continued successfully in this quarter. He cited a steady march of financial improvement in the form of adjusted EBITDA that has improved each quarter since the beginning of 2022. All that being said, however, they are still burning capital on a net basis. So credit where credit is due, at least for Redwire. They have less capital than the other two, but they are burning it slower, at least, than the other two. And there are some positive signs here. They are cash flow positive and adjusted EBITDA positive. So some, glimmers of light, but they are still at the make or break time for the company, right? So if they go profitable, then they'll just continue on from there. If they run out of money before they can get profitable and they can't raise capital to continue funding their staff and funding their operations, that's all she wrote. Those are our three companies that are hitting their moment of truth over the next couple quarters. We're going to see whether they make it or break it. What do you think is the most likely company to be successful? What company do you think is the most likely to go out of business? I'm going to give you my Dave's take here. Sorry I didn't do the little animation. I like doing that, but it's difficult on this old computer. I'm getting my new computer set up, and when that gets ready to go, hopefully I'll have the systems in place. So, my take is if I had to buy one of these three, it's probably Redwire. You can see from their stock price, they're not in danger of being delisted. Their cash position is low, but they're burning slowly. They have become adjusted EBITDA profitable. And, if one of the three is going to break even and make it, I think my money's on Redwire. Let me know what you think in the comments below. I do have to admit I'm less knowledgeable about Momentus than the other two. Sounds like an interesting technology with the water-based propulsion, although it may be a bit of a gimmick. But they also seem to be in a bit of trouble. Either way, it's going to be extremely interesting to watch what happens for the next few quarters, and I'll be sure to share that news with you. The other question, I guess, could be, would I short one of these companies? Would I sell puts on them? I don't usually do that. I guess it's an option. I don't have a ton of capital free right now. If I did have cash sitting around, I might consider it. Right now, I'm not seriously considering shorting or buying puts on any of these. Just going to kind of see, watch how it goes. I'll share the news with you guys. If I get more capital, maybe I'll buy a Falling Rocket Lab or Falling Planet Labs or some of that kind of stuff. Definitely something, I could think about. It's all a part of the game. The big institutional guys short companies all the time, so why shouldn't we if we can see the writing on the wall? Too, Anyway, that's it for today. I hope you'll subscribe if you find this video interesting. Thank you so much for watching to the end. I hope you have a great day, a great weekend, and I'll see you in the next video. Bye for now.